We're witnessing a lot of hype right now in the EV space, which I'm sure is no surprise to you given that you're watching this video, but a lot of this is now extending to EV charging networks, things like Chargepoint, EVGo, Blink Charging, and Volta. So we're going to take a look at those EV charging networks in terms of stocks and what makes the better investment by comparing them to one another, and also extending beyond the pure play charging networks to Tesla Supercharger, which obviously needs comparison, and Volkswagen's Electrify America. So let's get right into it. Before we do that, hey everyone, my name is Bill Hawk, and in this channel we talk about stocks, crypto, real estate, and investments in general. So if at any point in this video you receive some value, please hit the like button and subscribe because it helps me out with the YouTube algorithm, and I'm trying to grow this channel because right now it's just too small and I put a lot of effort in, so I'd really appreciate it. Thank you very much. If you're completely new to EVs and EV charging, which I'm going to assume for the purposes of this video, the first place to start is to get a basic understanding of how charging works and the three levels of charging. Level 1 charging uses a common 120 volt household outlet, you know, the ones that you're probably seeing in your room right now, which is the most basic version, and it's very slow. It adds about 3 to 5 miles of range per hour, which is pretty slow, and honestly in my opinion it's just an impractical solution, maybe for hybrids, but we're talking about the future of EVs, so for the purposes of investing, I just think it's not investable to even look at anything that's relating to level 1 charging. Level 2 charging is more commonly used at home and public locations. It's a 208 to 240 volt, which can power 12 to 80 miles of range per hour, which is quite the improvement from the level 1. We're talking 4 to 16 times faster. And level 2 charging typically would fully power an EV overnight. So this is a more practical solution, and it's basically those outlets that we use in our dryers and our ovens if you're using an electric oven. Finally, level 3 is known as DC fast charging or supercharging, and it wouldn't make you a genius if you guessed that this is the fastest available EV charging out there at 400 volts to 900 volts or 3 to 20 miles per minute. So not hours like level 1, but 3 to 20 miles per minute, which is crazy, much faster. Level 3 superchargers aren't installed at home because they cost tens of thousands of dollars, and it just doesn't make any practical sense when you can use a level 2 and just charge your EV overnight. But they make sense in public locations, in malls, or stopovers. If you're driving a long road trip, obviously you don't want to sit there overnight to charge your EV, you want to charge fast. So in public locations, level 3 makes a lot more sense. But interestingly, when you take a look at public EV charging stations by type, so level 1, 2, and 3, you'll see that level 2 is actually the most prominent, which to me, honestly, it just doesn't make sense. I'm trying to understand why we're building out level 2 charging infrastructure when we know level 3 is probably the better solution for the future. If all this just blew past your head, then don't worry. Here's a summary of the 3 levels of charging, level 1, 2, and 3, which you can also get, by the way, by being on my email list. Make sure you subscribe. The link is in the description. I highly recommend it. But now that you're an expert in EV charging, let's take a look at the different companies and networks to see what makes the best or better investment. The conversation for charging networks should always start with Chargepoint. They're the leader by far. They have most of the market share. They have most of the charging stations and charging ports out there. So let's start by taking a look at an outdated visual. I don't have a new one and wasn't going to build a new one in full transparency because I don't have enough subscribers. Now, if you haven't already subscribed, then this might be your cue if you want some updated graphs. But you can see here, they lead the market by far. If you're more of a numbers person, here you can see another visual where Chargepoint has the lead by far in terms of locations and connections. Tesla and EVGo I pointed out because of their lead in DC fast charge or supercharging. As I mentioned, the numbers you saw are a bit outdated, and sure, the numbers might be a little higher now, but the hierarchy hasn't changed much, which you can see that Chargepoint is the king of EV charging networks. And they proudly state on their website that they have more charging locations than the number of Starbucks, McDonald's, 7-Eleven, Dunkin' Donuts, and Walmart. ChargePoint's massive charging network is driven by either CapEx or OpEx customer purchases. So either they're buying the machines outright or they're engaging in some sort of subscription. So that's their commercial product line. And then they also have a fleet product line for charging and managing fleet. They recently acquired eBus and Vericity to advance their fleet management efforts. And finally, they have residential products for single and multifamily homes for at-home charging. ChargePoint's OEM partners include GM, Nissan, Benz, BMW, Fiat, meaning all of their cars fully integrate with Chargepoint software and its network. So in terms of size and diversification, honestly, Chargepoint really doesn't have any competition. But we'll get into valuation before we talk about some other competitors like Volta. Volta is a unique charging network in its own way. Its model is very intriguing and innovative. It's very tech forward and very Silicon Valley-ish. Unlike Chargepoint, it owns the infrastructure, which can be a positive or negative depending on how you see it. I'll give you my thoughts on the end. So they're also driving electricity sales and, more interestingly, advertising revenue from the large screens on their chargers. They deliver the ads through their media partners, which seems to be effective based on the Whole Foods case study, which increased the brand sales by 35%. They're taking the media world and bringing it into the EV charging space, which is completely unique. This is reflective in their margins, which you'll soon see. Volta offers a lower cost of charging to their customers because the advertising model supports it. In fact, you can charge your EV for 30 minutes for free at any Volta location in exchange for having a big ad thrown in front of your face. So it's essentially like the freemium model. But in terms of size, they're much smaller than Chargepoint. Chargepoint has over 120,000 chargers. Volta, on the other hand, has just over 2,000. So it's basically like an ant. There's not much locations. They're at a very startup stage, but they do have something unique here. So I'll give you my thoughts on the whole thing later. EVGo is another charging network which came public via SPAC, and they're doing very impressive things. It's not clear how many chargers they have, as they have 800 stations listed publicly. Based on the author from this Forbes article in September 2020, I'm guesstimating they have close to 15,000 chargers in their network. I'm not so sure of this, so don't hold me to it. I'm just guesstimating here because it's not clear, but their list of OEM partners is very impressive. So they have Nissan, BMW, GM, as well as Hyundai, Kia, Ford, and even Tesla. The fact that Tesla decided to align with EVGo is interesting, but also not surprising. EVGo is focused on purely level 3 DC fast charging or supercharging, which aligns with Tesla because Tesla is also focused on their supercharger network. So this would just be an extension to their supercharger network, which makes complete sense. And as we said earlier, supercharging makes the most sense to me in public locations. So this just makes a lot of sense. EVGo also has unique partnerships with fleets like Uber and Lyft, which, again, if you think about it logically, Uber and Lyft drivers would need DC fast charging instead of level 2 charging because they'd be wasting their time just charging their cars instead of getting paid. And they just seem to be very well calculated with how they're deploying capital and doing so tactfully and expanding as it makes sense. The EVGo business model, in my opinion, is just a bit more future-proof because it's focusing on level 3 fast charging instead of the level 2 charging, which in my opinion might go obsolete. And the reason why I say this is because we're going to have advancements in battery technology where we're going to get bigger and better batteries, which may only be supported by level 3 fast charging. So level 2 infrastructure that we're building out just might go to waste. Again, I don't know. I'm not an expert. This is just my opinion. Unless, of course, we go to battery swapping technology like NIO is doing in China, but the likelihood of that is probably pretty slim. The other advantage that EVGo has is the fact that it uses 100% renewable energy. This is a huge alignment with Biden, the infrastructure plan. I think this is going to be a huge factor. Finally, we have Blink Charging, which in terms of numbers is Chargepoint's biggest competitor. They have 30,000 chargers in their network, either sold, deployed, or contracted. Their model is similar in that they either sell the hardware directly or they operate it in exchange for a subscription as a service. They seem to be expanding very fast and innovating, but I'll be honest and just say copying. They seem to be copying Volta's model and releasing it in 2022 to generate advertising revenues, which you can see here. This is where I believe size matters, and this is where I believe it is a race, and you have to try to get as many chargers out there in the network, because if not, this happens and then you get crushed by the larger competitor. So, all right, so now we're going to talk about valuations and compare the different charging networks, the part you've been waiting for. So as you can see here, and as I've been mentioning, Chargepoint is a giant, 133 million in revenues in 2020, and you can see the rest are pretty much negligible compared to Chargepoint's revenues, which is again the leader by far. And you can see this up until 2024, their forecasted growth, which I have here, almost $1 billion in 2024. There's a little bit of catch up happening. Again, these forecasts are available to members of my email subscribers, my email list, and you can get this by accessing the link in the description. Now, these numbers came directly from the investor presentation, so I'm taking this with a grain of salt, but I'm actually putting some trust into their numbers. But you can see here from 2021, at least we have some history of how they're performing against their own numbers. So Chargepoint, these three are all SPACs, raised their guidance from 198 million, so they actually raised it quite a bit. Volta had lowered their guidance from 47, so they, according to their SPAC presentation, was expecting to do 47 million, where they ended up doing 34. So right off the bat, I don't like that because it doesn't give me much confidence in these numbers. And we don't have a lot of history to really be confident in anyone's numbers and any analyst. So in this case, I use the analyst means, but again, how much history is there to be confident in that? Not a lot. So in terms of EVGo, also they raised their guidance from 21 million to 22. So at least there's some raise there, which I like to see. So right now, in terms of revenues, the most confident I feel with is Chargepoint and EVGo. And Blink, of course, is up there because this is probably the most conservative as well. And then we have their gross profits, which I really just wanted to see their percentages in terms of the margins and net income margins. And you can see here, sorry, this should be margins, not year over year. I'll just fix that right now. And you can see here, Volta has the 30% gross margin, which is at least 10% higher than the competition. And the reason for that is the advertising model, in which you can see now Blink is charging, Blink is not charging, they're copying, and they're going to be probably likely seeing an increase in margin by copying this model. But that's not to say that Chargepoint and EVGo can't copy it either, right? This is the problem when you're growing too slow and others are growing much faster, they can just crush you. So this margin here, by the way, is excluding depreciation and amortization, which EVGo presents. So I'll just put that in there for those of you who are really going to go into the details, which I don't expect all of you to do, but I'm going through it right now. So the bottom line is Volta has the highest margins, 30% gross margin, where the rest is about the same at about 20%. And that's because of the advertising model. And of course, that's should be reflected in the net income, but you can see net income, there's a lot of differences. Now EVGo looks a lot better than reality. It looks like we're at 380% margin and they're profitable, whereas the rest are not profitable. The rest are probably honestly looking to be profitable at around 2024, 2025. EVGo is not profitable because there's a 45.9 million impact from the change in fair value of warrant liabilities, which is this new reporting thing, which the SEC mandated SPACs to do. So there might be a negative impact. In the case of Volta, there was a negative impact, and in this case, there was a positive impact. We should technically remove this to really understand their margins if we're going to compare them. So I will do that for you right here. So we're going to subtract 45.9 from here, which obviously will give us a negative number. And now we're at negative 360% in terms of margins, which now aligns with, you know, the rest of what we're seeing here. But Chargepoint so far seems to be making a pretty good progress towards profitability. Now this should be, if we add back the negative fair value adjustment for warrants, plus 11.5, you'll see, okay, yeah, now we're all pretty much in the same net margin category, but I think they'll all probably be profitable or have positive EBITDA by 2024, 2025. So this is a risky game, of course, because you don't know, but this is kind of speculative. Not kind of, it is speculative, but you know where you're betting, because obviously charging infrastructure needs to grow. There's no doubt about it. You know, so there's that. In terms of chargers, which I've been talking about throughout the video, you can see here 118,000 ports for Chargepoint, 3.7K DC fast charge, which again, to me, that's a concern because they're lacking in that category. Level 2 is only going to get us so far, in my opinion. I don't know, I'm not an expert, but it just doesn't logically make sense to me that we're going to go out and charge level 2. We really need level 3. It just makes a lot more sense to me. Volta has the lowest, which you saw, and EVGo estimated about 15,000 based on that article and the information we have. And Blink, again, as I mentioned, is the leading competitor for Chargepoint in terms of numbers. So valuation, now the most important part, of course, right here. Blink is just a ridiculous valuation, 60 times 2022 sales and 16 times 2024. I'm failing to see something to understand why it's this high. Maybe you guys know. Let me know in the comments if you're a Blink charging shareholder. I just don't understand this. So now Chargepoint is, of course, the benchmark at 25 times 2022 sales, which is a lot lower than here, and 8 times or 9 times 2024 sales, which honestly is pretty damn expensive. Like that's pretty expensive for the speculation that we're taking. There isn't a lot of margin of safety here when you take a look at, you know, us trying to normalize it, the price to sales to about 4 or 5, which I do based on 2025 and 2027 sales to get to my price target. I use a weighted average of these two, giving most of the weight to the 2025 target to be more conservative. You can see this is pretty expensive, and honestly, I just don't see much upside here if we're going to see a price to sales of about 4 or 5. Which seems reasonable to me. I just don't understand why it would be much higher or stay this high. We honestly don't know how these things are going to trade. So to me, that's the risk that I'm comfortable with taking. Of course, you're free to take any sort of risk you want, which is why if you want access to this sheet, you sign up to my newsletter and you can change this number to whatever you want. You want to change it to 8, go ahead. You want to change it to 9, go ahead. That's you, but this is me. So I'm just showing you what I'm going to do, and of course, you know, I'm not telling you to copy, but you can use this as inspiration. So to me, in terms of valuation, Volta and EVGo are the most attractive. They're trading at about 3 to 4 times 2024 sales. So to me, that's okay. That, like, I'm willing to nibble there. I'm willing to accept that. I bit into Chargepoint more of a trade, and I'll get into that later in my conclusion. But to me, these valuations are a bit more attractive. I'm not going to say they're attractive because we're still talking about a company that's in negative earnings. But if we're talking about in this space, this makes sense to me. So this is why EVGo, to me, has the highest upside from the valuation where it is today, because I do believe that they're building the right way. They're building the level 3 fast charging. So I just don't understand why. Now, I know this stock has taken a beating lately because of analyst downgrades, so this could be why. So to me, EVGo right now in terms of valuation is the most attractive. Before I give you my concluding thoughts, I want to talk about some of the risks, which I usually do, because they're important to consider. So execution risk is the first one. Because we're projecting so far out, we're not sure how these companies are going to execute, which of them are going to make mistakes, and how they're going to learn along the way. So there's a lot of execution risk because we're building out a projection which is very far out, and there's a lot of unknowns. So this is something to consider. There's also competition risk because there's so many competitors here. They're probably going to try to look to outprice each other, come up with ways to gain as much market share. Every time this happens, think Uber and Lyft, you know, they're just squeezing margins and they're driving profitability further and further out, which is an overall negative for the industry and shareholders and the model in general. So we just don't know how this is going to play out. And finally, we have technology risk, which I mentioned over and over again. Technology is developing very, very fast in the EV space. So we just don't know the infrastructure that we're building today, whether it's viable for the future. So to wrap it up, I'll give you my thoughts in terms of what EV charging network I would want to go with, which one I would want to own, and which one maybe I'd want to trade. So I did mention that Chargepoint I did own, and I took that as more of a trade because I saw the breakout in the channel and it was just a good entry point. The graph just looked beautiful and I took it and ran with it, and I made about $1,000. I took the profits. I still own some, so I'm gonna decide whether I want to keep it after this video. I do think, again, they're the leader and the market dominator, so it's hard not to own them, and I always feel like it's a mistake not to go with that trade because that might be the one that wins in terms of stock price. So it's hard to not do that and then regret it later. So I might just keep my feet in there. But in terms of the valuation, in terms of the companies and how they're building out, honestly, EVGo just seems like the winner to me. Again, mostly because they're building out the supercharger network. They're aligned with Tesla. There's the most Tesla EVs on the road than any other EV right now. And they're also aligned in terms of 100% renewable energy, and the valuation is just the most attractive. So it's just almost a no-brainer to me as to why EVGo is the winner. So that's the one that I'm going to start a position in. I'm going to start nibbling into it right now because I know the stock took a hit after some analyst downgrades. I do think that there's 150 to 200% upside here with the stock if you're going to be patient with it and ride it through. But the key is to ride it through because EV charging, again, we're building out models that are very far out. We're going to see a lot of volatility here, ups and downs. So if you're willing to hold it out, I do think there's upside here, which I am. So for me, it's a small position. I don't build my portfolio purely around these special situations. This is a very small part of my portfolio, max 10 to 15%. And I take these big bets for upsides rewards. Obviously 150% to 200% is not something small. So that's where I take a small position in these and build it out. But of course, you're free to do what you want with your portfolio and I'm not going to judge. But I hope this video helps and gives you some more of my thought process and how I'm going to approach it. If you have any questions, comments, or something I missed, leave them in the comments. And if you haven't liked the video or subscribed, here's your final chance to do it. I really appreciate you watching and I hope to see you on the next one.